The housing crisis in Canada seems to be growing every day. Canadians are faced with rising rents, rising mortgage costs, and skyrocketing home prices. The trend on housing in this country has a lot of Canadians wondering, how much longer can this last for? Well, our next guest doesn't think that the show can go on forever. In fact, he's gone so far as to say that Canada is sitting on one of the largest housing bubbles of all time. Joining us now to discuss the prospect of a housing bubble is Philip Colmar, managing partner and global strategist at MRB Partners. Philip, thank you very much for joining us on Forum Daily.
For having me.
So obviously, this has created quite a stir. A lot of people have turned their heads and really focused on your research here. But can you give us the lay of the land or some of the key reasons on why you think Canada is in fact in a housing bubble?
Whenever you want to characterize something as a bubble, particularly housing, you've got two things to look at. You've got the house price action, and then an equal bubble is the underneath the surface, what's supporting that, in this case, leverage. So when you look at home prices, we've seen a dramatic escalation in home prices, and really in the last 20 years. But due to overly easy policies, I would say the Bank of Canada tried to follow the Fed when it probably shouldn't have, when the U.S. was going through its housing bust, and Canada wasn't experiencing that. So we got low interest rates, which supported the
Really
whole
quick,
thing.
when you
Yeah.
say following the Fed, you mean keeping interest rates low?
Yeah, they kept interest rates too low for the Canadian economy. They didn't want to lift them higher than the US because that would have encouraged the currency to go up and it might have hurt the exporters. So they looked at the exporters, kept interest rates too low for Canadian housing, and it encouraged more house price appreciation or house prices to go up, people to pile into the market. And so we saw that after the pandemic, we saw more of it. We had some fiscal government stimulus, but we also had, again, easy policy. And so we got a boost of it. And so when you look at normal ratios of just how much house prices have gone up in real terms, you look at it relative to incomes in particular, you start to see that, okay, house prices are at nosebleed levels here. They've gone up, they've vastly outstripped incomes, and it's becoming more unaffordable. The affordability also gets into the question of interest rates as well. And so house prices are one side of it, and it was expensive but manageable until interest rates started to surge, and then it became unaffordable for at least new buyers. So that's certainly the one bubble, but the more alarming thing, and the reason why I suggested it was one of the biggest ones of all times, is you have a debt bubble underneath it. And that's actually where it becomes really problematic. If you have a house price appreciation, but you don't have the debt in it, then that's one thing. But Canadian households have way more debt to incomes than the US did at its peak of its housing bubble. And that's where the bite when you're dealing with an interest rate shock comes about.
And I want to dig into that difference in terms of income. How have incomes risen in comparison to home prices? Do you have a reference point for us on what that disparity is and how it's grown?
Yeah, since the low in about the 2000s, you saw house prices go up something like 300% and incomes go up 150. So there's been a big widening gap, if you will, in that. So there's been and actually at the pandemic, we hit an all-time high in terms of house prices to incomes. We pulled back a bit last year because house prices fell and incomes continued to rise. So that helped a bit, but it's still at pretty much its cyclical highs in terms, or structural highs, if you will. And then, as I said, the leverage underneath the surface. So affordability is excessive and incomes are high, but this is coming at a point when affordability is probably the worst it's been since the 1990s, preceding the downturn of the 1990s in the housing market. But debt levels, household debts burdens are way higher at this point. So if you think of like household, sorry, go ahead. Yeah.
I was going to say, is that what makes this different than simply a correction? Is that it's not just that housing affordability is a big problem, it's also that Canadians are over leveraged in other aspects of their life, whether it be line of credits, credit card, etc.
Yeah, that's really the thing is you saw, household debt to income has really surged. A lot of it's mortgage debt. So households are saddled with debt to income ratios are like 180% of debt to income. So it's quite high if you think about that's about 50 percentage points higher than the US had. A lot of that's mortgage, but it's also second cars, it's boats, it's other types of things, it's credit cards. They've taken on a lot of debt. And so when you're looking at a house price correction, that's one thing in terms of any asset correcting. But whenever it's backed by a huge amount of leverage, that's where you get into the viciousness of it, right? That's where you can end up with that downward spiral, that deleveraging. Like we saw in the United States, where the households had a downturn in the housing market, but then had to repair their balance sheets because they were
Mhm.
just so over their skis. And in Canada's situation, we're starting from a much worse starting point.
The Bank of Canada says that those with fixed rate mortgages could see their mortgage costs increase by anywhere between 20 to 25% in the 2025, 2026 timeframe. Essentially, is anyone who got a mortgage at a fixed rate relatively low, having to renew their mortgage and then going up significantly, let's say from 1.8% to 6. Do you think that that is part of the equation or the tipping point in terms of when or if a bubble pops?
If you've got a bubble in place, in this case, then the pin that bursts that bubble is one of two things. It's higher interest rates or it's a deterioration in employment conditions. Right now, what we have is higher interest rates, and that's
Mhm.
at the forefront. We're already seeing that. That's pushing it up to 2025, 2026 is a bit misleading because we're already starting to see those painful resets come about. So interest rates have been rising for over a year, and if you just look at the major banks, you look at their income releases and the structure of their mortgage outstanding as they report it, and you can see a dramatic escalation in the number of home buyers that can no longer pay the interest on that debt once it's
Mhm.
reset. So that's what we call negative amortization. So when your old payment that you were paying doesn't even cover the interest anymore, let alone the principal. And so we've seen some of the major banks report 20% of outstanding mortgages in that camp. And we're seeing, if you go back, 12, 18 months ago, we didn't have any mortgages with a duration or a maturity longer than 30 years. And now we have something like 25% of them. So what it's telling us is banks are concerned, regulators are concerned, people aren't paying for this right now. And
Yeah.
we're trying to pray that interest rates will drop here.
And I guess that's the big question. When a bank extends the term of the loan beyond 30 years and essentially a mortgage holder is just paying the interest, are the banks, pardon the pun, banking on interest rates going down within a 5-year period? Because, and you can correct me if I'm wrong here, when they do renew, it goes back to the original term, does it not? Or can they continue to kick the can down the road and essentially extend amortization indefinitely?
Well, that's unfortunately that's what's happening right now is we're in a situation that if interest rates don't drop meaningfully,
Hmm.
then we're in a situation where these are perpetual mortgages. Nobody ever repays them because we're not covering the interest. And so we're just kicking it down on banking on lower interest rates. And
Hmm.
my point is that interest rates, they're being driven up by global forces right now. Mortgage rates are mostly resilient south of the border. But if they just don't even go up, if they hold here, even from the Canadian government statistics suggest that we've refined 40% of outstanding mortgages have already been reset.
Yeah.
There's still 60% more to go. And that 60%, most of that will be done in the next 24 months. So at least double what we are. So whatever the numbers are that's alarming right now, that's probably going to double. Right.
Okay.
And so there's a lot of homeowners that are just in a squeeze here because everybody's banking on that interest rates will come down and bail the whole situation out. Unfortunately, interest rates are linked, at least to the 5-year level, are linked to the global basis.
And
So it's
And in terms of that bailout, because your critics have said, well, Canada has had the biggest population boom, largely driven by immigration, that is going to put upward pressure in terms of demand and outpacing the supply of homes. What do you make of that argument that immigration may calm the chaos or deflate the bubble at a much slower pace?
immigration's a positive in the sense of creating more demand,
Mhm.
but people have to think about putting that in check. So there's a few things on that. The first is, are those immigrants that are coming into the country rich? Right? Do they have enough money to buy house prices at current levels? Right?
Mhm.
Because that's really what you're asking. So are we only immigrating them? So we're not getting a working population, we're getting a wealth. That's a political debate to start with.
Yeah.
If we are employing people to work, can we create jobs for them? And more importantly, can we create jobs for them that pay better than Canadians are currently making? Because otherwise, they still face an affordability issue.
So
So,
just one counter to that would
yeah,
be they may not have the capital to buy a home, but they need to rent. And that puts upward
yeah,
pressure on rental prices and further incentivize the purchase of second or third homes from an investor level.
yeah.
Is that enough to maintain home prices or
No,
at least slow the decline?
It's certainly a positive to continue with immigration flows, but I would put in check that people are looking at low inventories in the market and saying inventory is just not there in terms of new homes. And what they're looking for, because there's bad statistics on it, they're looking at how much inventory is on the current market for sale. But
Hmm.
if you look at household completions, say since 1990, so a long period of household completions, pretty much every year except the last couple, it's outstripped household formation. And so
Okay.
we've created about 1.2 million more homes
Yeah.
than we have immigrations made up for.